This is one of the most widely cited papers in all of financial literature, and for good reason. It is an absolutely fascinating investment system that offers a better way to allocate assets. Is it possible to achieve stock-like returns with bond-like volatility? It's essentially the holy grail of investing, to be able to maximize your long-term returns while minimizing the possibility of having a huge drawdown of 50%, 80%. So in today's video, we're going to look at a research paper from 2013 that talks about a system that can do that very thing.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
The last 3 or 4 decades have been an absolute dream for the 60-40 portfolio, with 60 being stocks and 40% being bonds. This is the most common portfolio for retirees, and the reason is that there's been a lot of research to suggest that this portfolio is the best way to maximize your returns while minimizing your risk, therefore increasing the probability that you're going to have enough money to make it through retirement. However, last year's debacle with bonds and stocks going down at the same time while inflation surged kind of calls that portfolio into question. In fact, if you look back at all the data from all of these G7 countries, you find that every single one of them, the stock market lost 75% or more at least one time. And the unfortunate mathematics of a 75% decline is that it takes a 300% gain just to get back to even. To illustrate, here's the maximum drawdowns for the S&P 500, and in the Great Depression of the early 1930s, the S&P 500 declined by nearly 85%. There have also been multiple occasions where the market went on to decline at least 50% here, and again in 2008 and 9. Any good investment strategy, in my view, has to have a few key criteria for most investors to follow. And that is, first of all, that it's simple enough to follow. It has to be mechanical enough, maybe not completely mechanical, but mechanical enough to remove a lot of the emotions. And it has to have a successful enough track record to justify its implementation. And based on that criteria, I think Faber's paper outlines a strategy that accomplishes all of those things. The heart of his strategy is based on a trading system that's been around for decades. And that is the 200-day moving average, or in this case, another way to look at it is the 10-month moving average. And all the moving average does is basically smooths out the data to where you don't have all of these jagged up and down moves that the S&P 500 goes through. Basically, the idea is it shows you when there's a major change in trend. Faber points out in his paper that different asset classes perform very differently above and below their 200-day moving average. So for example, from 1973 to 2012, above the 200-day moving average, stocks produced an annualized return of about 13.5% per year and volatility of a pretty modest 13.8%. However, when the S&P 500 was below its 200-day moving average or 10-month moving average, the annualized return was significantly less at just under 5.5%, and the volatility was significantly higher at just under 20. So above the 200-day, you get better returns with less risk. Below the 200-day moving average, your odds of lower returns go up, and your odds of a major catastrophic loss also go up. And what's interesting is this also applies to other asset classes. For example, foreign stocks, meaning in this case non-US stocks, also generate higher returns with lower volatility when they're above their 200-day versus when they are below their 200-day. Results for bonds are a lot less helpful. You can see the annualized return is actually lower below the 200-day than above it, and volatility is a little lower but not much. So bonds don't seem to have as much volatility clustering. However, we do see the same thing happening in commodities. So above the 200-day moving average, they return 14.1. Below, they return 4.4. Volatility is a little higher above the 200, but very similar. Real estate, above its 200-day moving average, returns of 16.4. Below, actually negative returns, and then the volatility actually doubles below the 200 as opposed to above it. So if you just take an average of all of the asset classes, there is a substantial, almost 10% difference between total returns if you bought above the 200 versus if you bought below it. So that raises the question, if stocks do so much better above the 200 than they do below it, and if risks are elevated below the 200-day, what would happen if you basically just said, I'm only going to own stocks when they are above their moving average, and I'm not going to own stocks, I'm going to own cash instead when stocks are below the 200-day? According to Faber's research, he found that the 200-day moving average strategy, basically simply selling at the 200-day, increased your returns to 10.18%, compared with 9.3 for the S&P 500, just simply buying and holding. And he also found volatility was significantly lower at just under 12% compared with 18% for the S&P 500. But the biggest and probably most important thing for most people is that this maximum drawdown for just a buy and hold investor in the S&P was negative 83.5%, which is basically a catastrophic loss for most people. But compared with the timing method, was a lot less at 50%. But you can see consistently selling at the 200-day moving average reduces your maximum drawdown. So while the S&P 500 experienced these negative 40, negative 45, and negative 55% drawdowns, just simply selling at the 200 minimized those drawdowns to a much more manageable 25 or in some cases 15, 20%. And then you can see over time, just simply avoiding those major catastrophic losses has resulted in outperformance for this timing strategy. So you can see in almost every single year, the timing model helped you avoid those catastrophic losses. The only year that it was worse was back in 1973, when the timing model was modestly worse than the buy and hold S&P 500s. So what if you would develop an all-weather portfolio made up of stocks, bonds, foreign stocks, commodities, and real estate, and then use the 200-day moving average overlay to reduce the potential risk that each of those assets could experience? Faber did that very thing, and he called it the Global Tactical Asset Allocation, or GTAA for short. And he looked at this data going back to 1973, and he made two different portfolios. The first portfolio simply equal weighted each one of these assets and rebalanced it on an annual basis. So the buy and hold portfolio put 20% in stocks, 20% in foreign stocks, 20% in bonds, 20% in real estate, and 20% in commodities. And then he compared that portfolio against what would happen if you bought 20% of US stocks unless they were below their 10-month or 200-day moving average. In that case, you would hold T-bills. And what he found was that the timing model, so getting out below the 200 in all of those assets, significantly increased the smoothness of the ride. So while the timing model did slightly outperform the buy and hold, the main benefit was how smooth the line was. You can see that the timing model almost never has a single calendar year where it loses money. The only time was back in 2008, where it lost 0.59%. Of course, that compares with the S&P 500 dropping 37%, and his diversified buy and hold portfolio of all 5 assets dropped by 30%. So looking at Faber's summary, you can see the strengths of the system. The performance is very similar to the buy and hold, yet the volatility is substantially lower, and maximum drawdown top to bottom loss improved from negative 46 to less than negative 10. I don't think this is right for everyone. If you're someone who is definitely able to stick with a strategy over a very long period of time, I think buy and hold is probably still for you. I would put myself in that category. I'm 33 years old. I've got a long horizon before I'm going to retire. I love what I do, so I may never retire. But the point is that I can withstand a 75% loss. I have 15 years to recover and then continue to grow after that. But if you're someone that's nearing or in retirement, you don't have that luxury. So in this case, I think this portfolio could be, and I say could be, because I think you should do more research into it, but this could be an interesting alternative to the 60-40 stock bond split. I think this protects you a lot more against extreme events, particularly if those are caused by inflation, which, as we saw last year, can cause both stocks and bonds to go down at the same time. But if you're considering this portfolio for yourself, Faber gives some practical considerations. But the biggest and most important for most people is going to be taxes. Now, if this is in an IRA account or a Roth IRA account or a 401k, obviously there's no taxes involved with that. But if you're doing this in a taxable account, the higher turnover from this could result in more taxes. Faber cites that this system has a turnover rate of nearly 70%. But the difference between 70% and 20% may not be that bad. He cites a study from Gannon and Bloom that measure the after-tax returns for individuals invested in the S&P 500 since 1961 in the highest tax bracket. And what they found that the pre-tax return, meaning if you invested in an IRA, would have been 10.62%. If investors had a 20% turnover rate, that return falls to 6.72%. If you increased the turnover from 20% to 70%, the difference in returns was only 50 basis points or 6.27%. In other words, if your strategy currently has 20% turnover, increasing from 20% to 70% would only cost you about 50 basis points in taxes. So if the strategy you're considering implementing improves returns by that much or better, you'd be better off to go ahead and pay the taxes because returns will ultimately be better. But what about how this strategy has performed since 2013? How did it hold up last year? How did it hold up in 2020? I wanted to figure that out, so I did my own independent study using a website called Allocate Smartly. So from 1973 to basically today, which is Friday, February 10th, Faber's strategy on the left compared with the benchmark, which I used the 60% stocks, 40% bonds, basically had exactly the same total return, just slightly better, but basically the same. The key difference was the maximum drawdown, again, improved substantially. The worst return was negative 11.4 back in 2012, compared with the 60-40 worst return of negative 30. Volatility also declined significantly to 6.8% from the benchmark at 10%, and the number of months this was profitable went up from 64% to 70%. I would also point out that the annual turnover shown here is 154. In Faber's citation, he's just talking about one side of the trade. So in this case, it's doing both the buy and sell count. So if you just take this divided by 2, that would be equivalent to about the 70% that Faber cites in the study. This chart shows the maximum drawdown for Faber's strategy relative to the 60-40. His strategy's worst return was negative 11%, and you can see that the 60-40 portfolio experienced at least 5 drawdowns worse than that. Those of you that follow the channel know that I'm a big proponent of doing absolutely nothing, just buying great businesses and letting them do all the work. Call that my coffee can strategy, which I'm currently experimenting with, and I post updates of that portfolio both here on YouTube and also more regularly for my Patreon and YouTube member subscribers. I'm considering also including a strategy like Faber's. I think this is fascinating, not necessarily for myself, but potentially as a real-time experiment for people that are retiring or near retirement and looking for something that might be a little less risky. So I'm thinking about creating a new portfolio at either M1 or maybe another custodian, probably in an IRA account, and just tracking how something similar to this might do. So in the next couple of months, I'll probably be posting an update on that to my Patreon and YouTube subscribers. Thank you again to everyone who is supporting the channel. You don't need to support the channel to get access to content, but there is some bonus material if you do decide to support. So thank you all for that. I really appreciate it. Couldn't do this channel without you. As a reminder, if you're a supporter on Patreon or YouTube, I will be doing a Q&A video. I'm probably going to film that on Monday. So you have a couple of days to put in any questions that you have, and I will answer those probably next week and post that video. Also, the next coffee can update will be not this month, but next month, where I'll buy another round of 30 stocks with $3,000. I'm doing that quarterly now instead of monthly because of limitations with M1 Finance. I love reading interesting research, so if you stumble across anything that is interesting to you, send it my way. You can send it to my email address, which I'll post in the description below. Maybe I'll do a review of some of that research and give my thoughts on it. So thank you again for watching the video, and I will see you in the next one.